Hello monsters, let's take a look at Under Armour, symbol UA, Under Armour. Now, this is one of those stocks where we're gonna have to take small leap of faith, so I just want to say it up front because while the technical picture looks fantastic, there are some signs of unusual call activity picking up, which I bet is the type of action that nobody will catch. But the fundamental picture coming out and the news flow in the last couple months has not been so good. But this is a stock that has consistently traded at high valuation and always tends to surprise to the upside by blowing all expectations out of water. So I'm just going to go through screen by screen and show you exactly what I have. Let's take a look at technical first. Here is the daily chart right here. And as you can see that it came down hard late last year and it bottomed sometime in January and then it popped big time when it reported the last earnings report. Came back, filled a gap on low volume, came right back, and now it's just consolidating. Here's the 200 moving average. This is the pink line. Notice my favorite that I discuss all the time, these volume over price bars. So here, right here, just below the 200 moving average, this is your, I call it around $86 to $87 a share, is your volume over price resistance that starts to basically go in rear view mirror. The stock starts to break out, and then you go all the way up here, which is 95, call it 94.80 to be more precise, is where the next volume over price resistance comes into play. So in other words, if it breaks out here, and assuming this 200-day moving average that's up here around 88 does not matter, then basically if it breaks out here, it has potential to run all the way to 94.80. What I'm going to do here, just to simplify this chart a little bit, is to basically get rid of these moving averages because I don't care about them much anyway. So here's the chart again. Got rid of the moving averages. Now you see this is the level around $86 a level, around 86.50, and from here all the way up to 94.80 is nothing but just air pocket. That's what it is. It's a beautiful looking consolidation just below the resistance. Now another way of looking at it is, let's go to stock charts. Here is the chart. Now I want to show is the same exact thing in this particular case. So here's your big giant volume over price resistance, and then here's the next resistance. Stock charts is basically pointing out around 92.50 level. Thinkorswim is saying 95. It doesn't really matter. It's somewhere between in low 90s, which is about 10% higher from here. Is the next layer of resistance that comes into play. Doesn't matter. There's about at least 10% of air pocket. What I want to show here is this tight Bollinger Bands. Once again, this is a favorite setup because it tends to work all the time. So here you have, very, very, very tight Bollinger Bands. Look at the giant rally that we saw back in January, and then fill the gap on lower volume, fill the gap, earnings gap, came right back, again on slightly elevated volume, and now just consolidating. And with earnings coming out late April, this is basically forming a very tight Bollinger Band. So either expect a sharp breakout or sharp breakdown. So that's what I'm looking at. Now, so that's a technical picture. My target in this particular case is, let's call it 92 to 95 level. 92 to 95 level. Stock currently at 85.70, so that's about 10% to the upside. Now, if you go to the option market right here, I just want to show quickly. Here's the Under Armour, right? Now, let's see. Here's the Under Armour. Now, first that you will see is that the earnings are going to come out sometime. This is April 21st, so it is the week after April expiration, right? So here's April month, so it's going to come out this week sometime. But the bulls are not targeting this week. They're going out to the following week, which is the last week of April, and they bought 500 of these in the money last week of April. In the money calls at 85 strike, and they paid, I can tell you exactly what they paid. They paid $4.25 for these. $4.25 offer side for these, when the bid and ask on this was $3.80 and $4.20. So that's a 40-cent wide spread. They paid $4.20 for these, and then they bought 1,500 of the 86 strike calls, and those went off in two big blocks of 750 contracts each, and they paid 360 and 370 near the offer. So the bid on those was 340 and 370. They paid 360 and 370. So they bought 500 of these last week of April, 500 of the 85 strike calls, and then they bought the 1500 of the 86 strike calls. So pretty good size bullish bet in both of these. I mean, if you do a quick math, that's about $200,000 worth of calls bought here, and this would equate to about $450,000 worth of calls bought here. So between these two strikes, they bought about $650,000 worth of calls. Then you go further out to May, and you'll see the volume right here. So there, somebody came out, and this was just before noon, and they sold a block of 1,000 May 80 puts. They sold these puts at $2.20 credit. They sold it near the bid. The bid and ask at the time was 220 times 230, and they sold it for 220. So they sold it actually the bid and ask was 215 times 230, and they sold it near the bid, just 5 cents basically above the bid, for 220. So they collected about $440,000 for selling these May 80 puts. I always like the fact when somebody is selling puts under the stock, because that tells me conviction. You know, it's a much more important to see when put sellers are showing up rather than call buyers, because call buyers could simply be speculative trade with limited amount of capital at risk. So we have put sellers. We have last week of April is seeing call buyers. We have a chart that is setting up for breakout from this volume over price resistance. It is forming an extremely tight Bollinger Bands right here. If it breaks out, I see 10% to upside. And now on the fundamental side, which is kind of not so great, but again, we have to take these analysts sometimes with their, just what they say, without totally unnecessarily completely believing it. So what I want to show is that here is my note. If you go to right here, this is from the Market Digest. I just want to show over here. Let's see. Actually, let's do it this way. Here now. This is what gets my interesting. Back on January 12th, this is the January 12th, I showed a note in my chat room in which Morgan Stanley cut the stock to underperform, sharply cutting the price target from 103 to 62. I mean, major cut. You can go to the activity tracker and pull up this link, and you'll find exactly what I mentioned on January 12th. Morgan Stanley was so bearish that it was unbelievable. I mean, just the writing of it tells you. Going back to the chart, here's that point right here. You see, on January 12th, this thing basically crashed big time. It was partly also because the overall market was rolling over, but basically it crashed big time right here. Morgan Stanley did the damage that they wanted to back then on January 12th, but quite frankly, it had no lasting impact because the earnings came out, and that's what we saw. Q4 earned EPS was 48 cents versus 46 cents estimate. Revenue was 1.17 billion versus 1.2 billion. And fiscal year 2016 revenue guidance was raised to 4.95 billion versus 4.9 billion. I mean, there was no slowdown here. The company was raising guidance despite what just a few weeks before that Morgan Stanley was coming out cutting. But that did not stop Morgan Stanley from coming back and making more bearish case. They came back on March 3rd, and they basically just hit it one more time, talking about Q4 SSS sales to go, basically be flat to down 3%, and it was significantly below the street estimate. Then we saw another bearish news on Under Armour, where basically a key executive, Dave Dombrow, basically left Under Armour and went to Nike, which also got attention. But none of that affected the stock because it was coming out of very solid earnings report. I mean, Morgan Stanley kept firing back and back nonstop, but it did not affect the stock. I'll show you one more example. This time it comes from Credit Suisse. And here, this is from January 28th. So this is after the company had already posted earnings. So again, company posted earnings on right here on January 28th. So this is the day after that. And here, Credit Suisse once again talking about declining margin, ROIC is still concerned. I can just go on and on. They talked about very strong footwear sales of 31% versus expectations of 28%, but they basically said that that's the new growth driver, but the biggest bread, butter for the company is apparel, and apparel slowed. Okay, big deal. It slowed from 23% growth rate to 22%. Give me a freaking break. And then it goes on basically to talk about on the guidance. It highlights lack of leverage on accelerated revenue growth. They believe that the 25% revenue growth to $4.95 billion the company guided is not attractive, essentially, and it's subsidizing some of the forward growths with return dilutive investments. They basically put a chart next to it. They said this is ROIC, stands for return on invested capital. So basically the investments the company is making, they see that the return on the invested capital is going down from 18% to 14%, blah, 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 blah. I can go on and on and on and on. But did that do anything to the stock? No, it did not. Yes, it did fill the gap. It came back and it continued to trend higher. That's what happens to high quality stocks, with simply very innovative companies that simply find a way to continue to reach into new markets and continue to grow. That's the case with Under Armour. I understand the stock is not cheap on valuation. I think it trades at what? I think it's got $2.50 earnings power. I mean, I can quickly take a look right here. Right here, it has an earnings power of, so here, $1.31 earnings power, basically, which is going to be about 25% growth rate year over year. So on an $85 stock, this thing is not cheap. It trades at what, like 60 sometimes forward earnings. Another concern I will also point out, that because of all these bearish views from different analyst community, the short interest is rising. I mean, short interest in this stock is 15.9%. How big is that? Well, let's take a look. This is the short interest report. It has essentially doubled from, let's call it, since September of last year, when it was 14.4 million. So back then in September it was only 7.5% short interest, and now it's 27 million shares are sold short. So the short interest is doubled to 15%. So you have shorts piling. You have Morgan Stanley trashing the stock big time since January. You have Credit Suisse, and I can go on Bank of America and a bunch of other analysts saying the same exact thing, talking about return on invested capital going down. But you know what? This is a great franchise story. This is a great stock with a very innovative company, and you have to give them benefit of the doubt when they come out with an earnings report like this, and they beat on top and bottom line, and they raise the guidance. What is to say they're not going to do that again? I mean, so and the stock is speaking for itself technically. So again, I'm taking a bit of leap of faith with this one, because the technical picture is good and the bullish activity is taking place. You also have to, by the way, just because bullish activity here, you also have to kind of take it with a leap of faith, also because short interest is indeed 15%, which means we don't know. These could be actually bears hedging by buying calls, right? So that means my entire thesis is just shot dead. I mean, I could be completely wrong on this, because these could be bears basically piling into shorts and just buying calls as a hedge. So a lot of things that are not perfectly fitting into this. So, but you know what? If it breaks out over here, I see it 10 to 12% to upside. I could see this going all the way to 95. And let's not forget the simple fact: very, very tight Bollinger Bands. So how would I trade this? I would do nothing. I would just go simply straight and make an earnings play. Now, you don't have to do this today. You can come back the day before earnings, and then you can make a play. But if the stock starts to break out, then you might lose out on that. So maybe you can actually do the trade today. But the simple case is that here is April, and the week after that, on April 21st, let me confirm that date. Yeah, on April 21st, which is the week after April, they're going to be reporting earnings. No rocket science needed. Just go straight to that following week and buy 86 strike calls. You can pay about $3.50 for these today. Now, considering earnings are coming out that particular week, which means you can probably make a spread and do a diagonal, so you can buy those for $3.50, 86 strike calls for $3.50. And sell maybe 87 or 88 April calls, and collect either about $1 for these, or 88 calls, maybe collect about 60 cents for these, so you can lower the price a little bit or lower the cost a little bit. But as a rule of thumb, again, going back to the Bollinger Bands, when you have a setup like this, generally speaking, either make a direction, and you're making a directional play, you're better off just buying straight calls, because you're simply looking for a breakout and a run higher. I mean, to give you an example, remember what got us excited about Raytheon was the same exact thing. Look at the Bollinger Bands. We own calls on this because, you know, we did the same exact thing. Look at the sharp breakout, tight Bollinger Bands. Another one that I mentioned just today, GPS. They're seeing put activity in this. Look at this tight Bollinger Band. They're betting that this thing is going to break down. I mentioned this in chat earlier. I mean, there's a few other examples that we have shown of tight Bollinger Bands. So when that usually happens, you're better off doing no spreads but buying straight calls. That's it.